What happens when a single set of demands from one political figure sends tremors through global markets in a matter of hours? And why are investors around the world suddenly scrambling to reassess risk exposure they thought was already priced in? This is the question financial analysts and institutional strategists are wrestling with right now, as reports indicate that recent statements and policy demands linked to the Trump political apparatus have triggered immediate reactions across equity markets, currency pairs, and commodity pricing mechanisms. The story is spreading rapidly because it touches on something deeper than a single news cycle. And that something is the growing realization that traditional models of market stability may no longer apply when political signaling becomes a primary driver of capital flows. To understand why this moment matters, you have to step back and look at the broader economic architecture currently under strain, and that architecture is showing cracks in multiple places simultaneously. The Federal Reserve finds itself caught between inflation concerns that have not fully subsided and a labor market that is beginning to show signs of softening in key sectors. And this puts the central bank in a position where any external pressure, whether political or geopolitical, adds another layer of complexity to an already difficult decision matrix. Sources familiar with internal Fed discussions suggest that officials are increasingly aware that monetary policy alone cannot insulate markets from politically driven volatility. And this awareness is shaping how they communicate forward guidance, even if they cannot say so publicly. At the same time, the Treasury Department continues to manage a debt load that has now crossed $34 trillion, and the cost of servicing that debt has risen substantially as interest rates remain elevated compared to the near-zero environment that defined much of the past decade. This means that every spike in Treasury yields driven by uncertainty, every moment of hesitation from foreign buyers of American debt, and every signal that suggests unpredictable policy shifts ahead adds pressure to an already stretched fiscal situation. Now enter the political dimension and the role that Trump plays as a catalyst for market movements. Whether through direct statements on trade policy, tariff threats, or demands aimed at specific industries or nations, the effect is consistent, and that effect is volatility. Reports suggest that recent demands linked to reshaping trade terms with key partners, including discussions around renegotiating agreements and imposing new import levies, have created immediate uncertainty for multinational corporations trying to plan supply chains and capital expenditures filings from major logistics and manufacturing firms indicate that procurement strategies are being revised in real time as executives attempt to hedge against scenarios where tariff structures shift without warning. This is not speculation about what might happen in some distant future, and this is capital being repositioned right now, based on perceived risk tied directly to political signaling. The bond market has responded in kind, and analysts tracking the yield curve note that recent movements reflect a market that is trying to price in not just economic data, but also the probability of policy shocks that fall outside traditional forecasting models. Officials at several major central banks outside the United States have signaled through carefully worded statements that they are monitoring the situation closely and that coordination mechanisms are being reviewed in case intervention becomes necessary to stabilize currency markets. This kind of language does not appear without reason. And when central bankers begin referencing coordination, it typically means internal assessments have flagged systemic risk scenarios that require contingency planning. The European Central Bank, in particular, has been cautious in its public remarks. But sources familiar with the matter claim that internal discussions have focused on how European exporters would be affected if American trade policy shifts dramatically in the coming months. Asian markets have also shown sensitivity to these developments, with the yen and yuan both experiencing fluctuations tied directly to statements emerging from American political circles. And this brings us to the deeper structural issue, which is that markets are now operating in an environment where traditional economic indicators share space with political event risk in ways that complicate institutional strategy. Hedge funds and asset managers are increasingly relying on political risk consultants to supplement their economic research teams. And this represents a shift in how capital allocates resources toward understanding market drivers. What does this mean for what comes next? If pressure continues to escalate, and if demands from political actors continue to generate immediate market reactions, then several scenarios become more likely. First, there is the risk that corporate investment freezes as executives wait for clarity before committing capital to long-term projects. And this would slow economic growth in ways that take quarters to fully manifest. Second, there is the possibility that foreign holders of American assets begin to demand higher risk premiums, and this would push borrowing costs higher across the board, affecting everything from mortgage rates to corporate debt issuance. Third, there is the chance that retaliatory measures from trading partners create feedback loops that amplify rather than contain volatility. And these loops are notoriously difficult to manage once they begin. Officials in Congress have begun to signal awareness of these dynamics, with members of relevant committees requesting briefings on market stability and trade authority frameworks. Whether legislative action follows remains uncertain, but the fact that these conversations are happening suggests that institutional actors recognize the stakes involved. For now, the situation remains fluid, and the only certainty is that certainty itself has become a scarce commodity in global markets. Investors would be wise to monitor not just the data, but the signals, and to understand that in this environment, what is said may matter as much as what is done. The coming weeks will reveal whether this moment represents a temporary spike in volatility or the beginning of a longer period of recalibration across the global financial system. What is clear is that the architecture of markets is being tested, and how it responds will shape economic conditions for years to come.